I really wish I could sing, because I would sing It's a Lovely Day. It is a lovely day. And that song is stuck in my head, and I refuse to put it through my lips because it would do an injustice to the artists who actually sang that song. So we had some fantastic news, and I'm going to talk all about what's happening with the interest rates, what's happening with the CPI, all of that. I'm also going to bring up, I did a Tuesday live for 25 minutes, all on first-time homebuyer opportunities. I'm going to highlight some of those things and then push you back to the Tuesday live because we're doing a lot of classes. But here's our quote. So we're going to start out with a quote. Then Miss Megan has all kinds of data for us.
We had a good week.
Yes.
We had a good week in real estate this week. I was pleased to see the numbers come out this week.
I love that.
Yeah.
So we're just having a good time all the way around.
It's great. It's great. I was thrilled.
So we need that good week to lock in these low rates. So here's where we're going to start, because I have been blessed, and I know, Megan, you have, because you just talked about the fact that you've been running around town doing a lot of presentations.
So many presentations this week. So many presentations.
I love that, though.
Yes.
It means people are hungry,
yes.
right? Hungry for the information. I've been doing the same thing. I had a fabulous presentation last night with Karen and Amy, and we talked about how do you buy real estate out of state, right? So sometimes it can't be inside Denver, inside Colorado. We've got another presentation tonight. We've got Building an Investment Empire, where I have real estate agents all send their clients. Last time we had 70 plus people, and just getting them excited. It could be a first-time home buyer, it could be investor, whatever that is. I've got more first-time home buyer seminars and more investment seminars coming up. Chris Lopez and I are doing an evaluation on your investments starting next week. All of these things, right? All of the things I know you're doing, all of the things I know I'm doing. We do it for one reason. We do it to support you, to grow your business and support the clients ultimately with their decision to move forward, whether it's moving forward today, whether it's creating a strategy to move forward in the spring or the summer, or whether it's literally just putting them in your pipeline for next year or 2 years from now. It's not about your timing. It's about generating value for the client so that they know who to call when they're ready. So here's where my quote is. The best partnerships aren't dependent on a mere common goal, but on a shared path of equality and desire and no small amount of passion. Megan and I are passionate to support you with this information. We're passionate to have your success. We ask a favor in return. We ask for your business. I asked for your business on the loan side. Megan asked for your business on the title side. Ultimately, we are not economists, and we are not paid for this work. We are paid through the loans that you cherish us with and the title orders that you provide for Megan. We need these orders in order to keep doing this work so that we can continue to support you, supporting your clients. Because I believe in the dream of home ownership. I believe in the opportunities that real estate gives you. And I believe having this power of knowledge, having the data on a weekly basis on what the real estate market is doing and what the economics are changing in the psyche of your buyer and seller are key to you elevating yourself to a level of professionalism that stands out from everybody else. It is our honor and our pleasure to do this every week for you. Please do us the favor of supporting us with your business.
It's so funny how often I have this conversation with people where people think I'm just an economist. I'm a commission dependent salesperson with First American Title, and I rely on those title orders in order to be able to continue to do this type of work. And so your business means everything to us. And if you trust us with your business, we will take excellent care of you. So thank you for making mention of that today. So I'm making sure that people understand, yes, I'm a title rep. This is what I do for a living to try and help you better advise your buyers and sellers. And we certainly hope that if we're able to help you better advise your buyers and sellers, that they'll land with One Trust Mortgage or they'll land with First American Title. So please consider us for your next transaction.
Absolutely. On that note, why don't you kick us off? What did happen?
It was good.
I want to celebrate.
I had a good order day that came in on Monday. I was really pleased to see a lot of those numbers come through. And so it was great to see all of the numbers that started to come through. Oh, I think I shared that wrong. Let me try that again. This one. And so again, it was just a pleasure to see all of those. And I had a great order day on Monday. So I was just thrilled, and it was just encouraging to see all of these great numbers end up coming through. And I had more of a summer order number day on Monday and it's dropped off drastically through the end of the week, but I expect it to pick back up again as we go through Friday. P.S. We are closed tomorrow since the Federal Reserve is closed tomorrow. So we won't be in the office tomorrow, but we'll pick back up again on Monday. But this covers the week of November.
Note on that though.
Yes.
It is a non-funding holiday.
It is
right?
a non-funding
Obviously,
holiday.
the banks are closed.
Mhm.
We are open because with the interest rates dropping, I'm hoping, and you'll tell us how many homes everybody has to look at or what kind of the temperature of the market is.
Yes.
But certainly with the rate drop that we saw, which we'll talk about the CPIs, my team will all be in the office tomorrow and we'll be working this weekend because we're
Perfect.
really hoping that some of the pre-holiday sales happen
Yes.
this weekend.
Who doesn't want a new house for Christmas?
I do. I do.
So this covers the week of November 2nd through November 8th, going over the data. Looking at our strategy sheets here, you can see that the trend continued to cool off as we got deeper into the winter months, and we're starting to see more of that purge of expired and withdrawn transactions. When I pulled out and looked at the active inventory for October of 2022 versus what we've averaged from 2013 through 2021, we're right on pace with where we should be for active inventory. And so what I'm hoping is as we go towards the end of November, that we'll start to see more of that purge of expired and withdrawn transactions that drives our inventory down to help us kickstart our market in 2023. So we're still waiting for that purge of expired and withdrawn transactions. But this last week, our predictive month supply of inventory, where I take the active unit count and divide that by the pending unit count to give us an idea of which way our month supply of inventory is moving, dropped from 2.1 down to 2.0. And so our market actually tightened up this last week a little bit. This is the number that I look at to determine if we're in a buyer's market or a seller's market. And typically the cutoff for a buyer's market versus a seller's market is about a 6-month supply of inventory. Whereas anything north of 6 months of inventory is considered to be a buyer's market. Anything south of 6 months worth of inventory is considered to be a seller's market. Now, once we go below 2 months worth of inventory, it's considered to be extreme seller's market territory. So we're back into that extreme seller's market territory. Our active inventory finally started to drop off. We dropped down by 2.8% this last week, down to 6,900 total available units for sale. New listings had a little pop of activity of 5.4% with 781 new listings coming onto market. Back on markets jumped up a little bit with 253 total units back on market, which was up by 2.4%, making our fallout rate still about 8 or 9% for units that go under contract and then come back on the market again. Expired listings fell this last week because we had a big jump at the end of October. So we ended up seeing that there were 181 that expired. Withdrawns were up by 224. So now we're getting into that season of, oh gosh, the holidays are coming. I'm getting ready to put up my Christmas tree. Do I want to have showings during this time of in my house while I have all of my decorations up? And so we're going to start to see more listings withdraw and expire as we get closer to the holiday season.
And I was having a conversation with a real estate agent last night where the seller was like, just get it sold. Whatever you have to do. I'm tired of people coming through. The holidays are coming. I need this to get sold. So I really do think that there's opportunities where sellers have to sell and the market has shifted. We only still have 2 months of inventory.
We still only have 2 months worth of inventory at this point though.
Still a buyer's opportunity in that kind of seller psyche of what's happening.
And it's
right
again
now.
A lot of perspective that we're talking about here. We were looking at 0.2 months worth of inventory where everything was in multiple offers earlier this year to now 2 months worth of inventory. And again, this is the market that we've all been praying for the last 3 years in a row because our market was so upside down on supply and demand. And so we ended up going 120 miles an hour now down to the speed limit. And so now that we're back at the speed limit, buyers have the opportunity to negotiate, and the sellers that want to sell are really sticking in the market, keeping our inventory relatively high, comparatively speaking, versus prior years in our real estate cycle. So the sellers that want to sell are definitely interested in selling this year. We did see a jump in pending transactions. They came up by 2.5% this last week. Closed transactions were off by about 37.2%. Again, we end up having more units close at the end of the month, so I expect those numbers to fall. Month supply of inventory fell down to about a 43% chance of selling in the next 30-day period. This is where I take into account all of the available listings for sale versus those that go under contract and or close during the same week. Project that forward for a 30-day period of time, and it's about a 43% odds of selling. We're still far from a market imbalance where we only have about a 33.6% 50% of what we need to offset demand right now. So I'm not concerned about a further market correction. Every month I go through and I check out and see what's going to be happening with short sales, foreclosures, and HUD homes. And out of the roughly 3,500 closed homes, do you want to guess how many short sales, foreclosures, and HUD homes?
Can I guess?
You can guess.
Was it 0?
There was one.
There
was one short sale that happened last month, and it was a condo.
One short sale.
One short sale.
Got
so
it.
Again,
and it's not even foreclosure.
No, it's not even a foreclosure.
Right.
And so if people find themselves in some level of distress, they're able to list their home for sale and still what's considered to be a hot market, get out from underneath of that and walk away with all of the equity that they've gained over the last 10 years that we've seen in our marketplace, because we've had substantial appreciation in our market, which is very unlike what we saw back in 2008, where people were instantly underwater in their homes and short selling was the only option to get out of those homes. So we don't expect there to be this wave of foreclosures, short sales, or HUD homes making their way to market, because these numbers are just simply too strong.
And Black Knight actually put out a report that Diane Olick had picked up for CNBC, talking about the fact that we're losing so much value in our homes. I'm going to show that to you in a chart here in a little bit. But when you gain 44% in the Denver market since the pandemic began, and then we lose 7% of that, we're still ahead, right?
It's still ahead.
Unless you bought this year, and I understand, but the trick there is to not sell.
Right. Yes. And so there is a chance that if you bought earlier this year and you paid significantly over asking price, you could be upside down on your home right now. But again, don't sell your house. The expectation is that we're not day trading homes, that you're going to stay in this home for the next 5 to 10 years. And over that period of time, you're likely to see that appreciation in the marketplace. But to get to a balanced market right now, again, we only had about 6,900 total available homes for sale. We'd need to be closer to about 21,000 available homes for sale. So we're still far from a market in balance where we'd see a greater economic shift in our marketplace. Showings ended up going up this last week. We ended up seeing that there were almost 11,000 total showings that were set. Week over week, that went up by 3.4%. And that's probably due to Halloween being last weekend. Right. And people taking that time to go to Halloween parties and out trick-or-treating and trunk-or-treating and going to all of the different events that were happening. But showings did pick up. And so we saw 1.6 shows per property per week, which was up 6.3% from the previous week. So we did see a nice bump in showing activity, which was encouraging to see. Shows to contract is now up to 14 showings to go under contract. So if you've had a total of 14 showings and no offers, it may be time to consider a price reduction. But if you're only getting 2 shows per property per week, you could be on the market for as long as 7 weeks before you need to consider a price reduction. I'm seeing people that are still going out and slashing their prices early. I would say give it more time before you go through and make price reductions, because again, making a price reduction isn't always the best way to go through and market a property. It can fire sale it and make it go more quickly, but you've got to slow down the rate at which you're making price reductions. And I'm saying wait until weeks number 3 or 4 before you go through and make that price reduction.
That's probably the gold. Like you give a lot of numbers and they're all extremely valuable in a different way. But in this kind of market where sellers are stressed out about when should I start price reducing, or should I put my house on the market, or how long should I wait, or how long will I wait? That trifecta, those 3 strikes, to know what that is for your area and to have this information is the goal.
Yes. And there's a great report that you can pull from Showing Time under reports and target market analysis. So you can see how many showings are happening by price range in your zip code. And I would encourage you to rely on that heavily. There's also a great report that you can pull from InfoSparks in RE Colorado. Once you go to the dashboard page in RE Colorado, before you hit Matrix, go up to customer add-ons, I believe is what it is. And you can go to InfoSparks and you can see how many shows depending there were last month. So you can get those relevant numbers so that you know what they are for your area. You can even narrow it down to your subdivision for shows depending for that number. So you can get those good relevant numbers for your neighborhood. Median days on market ended up dropping by 7.7% this last week, from 26 average median days on market down to 24 median days on market. So that could be strike 3. Whereas if you've been on the market for longer than 24 days, then that's the point in time at which you would make a price reduction. Price reductions are still over 50%. It was 53.6% of all the homes that went under contract last week made price reductions. And so we still are seeing widespread price reductions across the board in Metro Denver. But the price reduction size did go down. It was a 7.2% price reduction versus the 7.9% price reduction that we saw last week, or about $50,000 off of the original price. And so price reductions, although they're widespread, ended up going down this last week. So that's encouraging to see that they're not quite as deep.
Do you think that that's because sellers are becoming more realistic on where they're listing the
I think
homes?
that probably,
Yeah.
I should, but I'm thinking that I wish I would have gone back and tracked the average list price for the week historically, so that I could see how much that average list price would have been, to see if people are pricing their homes lower overall. But I think that people are now understanding the fact that if you are looking at comps from peak pricing periods back in March, April, and May, we're now off by 10% from that peak pricing era, watching those prices fall back earlier this year. I was really closely tracking what was happening with interest rates, your monthly P&I payment, and your median household income. And now with that jump in interest rates that we saw last month, in order to get into a median priced home at a 30-year fixed loan with a 6.9% interest rate and 10% down, it was 50% of your average household income now goes to that P&I payment. So we definitely have an affordability issue, and I expect that prices will continue to fall, and they'll probably continue to fall until next spring. And so I'm not expecting there to be a big pop of activity right out of the gate like what we've seen in the past, unless we see interest rates get driven lower once we get inflation under control. But I think that most of the reports that I'm seeing is that interest rates will be lower probably in the second half of 2023 is what I'm seeing most frequently. Looking at the under $500,000 market, here's our strategy sheets for you. And again, the cooling trend continues to settle in as we get deeper into the winter months, but we dropped from 1.5 months worth of inventory down to 1.3 months worth of inventory. Our average daily active count is coming down by about 1.2%, or about 1,900 homes that are available for sale. Pending transactions had a big pop of activity this last week. They went up by 9.4%. We put 336 units under contract. Back on markets fell by about 3.8%. So those properties are sticking once they're going under contract. Withdrawn transactions ended up seeing an 11.9% increase over the last week. So there's the beginning of the purge. As we get closer to the holiday season, that'll drive our month supply of inventory back down. So it was nice to see this number tighten up a little bit. It's encouraging for sellers that are out there in the marketplace. Odds of selling came in at about 51.6% for homes that are up to $500,000. We're still far from balance, where we only have 21.9% of the inventory required to offset demand. In this market alone, we'd need to be closer to about 9,000 available units for sale to offset demand. So no market correction coming to this under $500,000 market. Shows per listing were about 2.2. So if you're not averaging 2.2 shows per property per week, you may not be in your target strike zone. So you might need to consider a price reduction. Layer that on top of 13 showings to go under contract. It came in at 12.7. So buyers are looking at a few more homes before going under contract right now. So if you've had a total of 13 showings and no offers, it may be time to consider a price reduction. We're looking at about 19 average days on market, which is down from the 21 that we saw over Halloween weekend. So encouraging to see that median days on market started to come down. So if you've been on the market for 19 days and no offers, that may be strike three to consider a price reduction.
Can we just double click on that?
Yep.
19 days is not very long.
19 days is still not very
It's
long.
not, it's just not.
No, it's not. If we want to compare that back to where we were from 2008 through 2012, we were looking closer to 120 days on market.
God,
So
now that's
19,
long.
yeah, that's a long time to be on the market. 6 months is a long time to be on the market.
Yes.
But being on the market for 19 days, it's really not overall that long. So when I see people going through and starting to slash prices in week number 1 or week number 2, I'm like, give it some time. It needs some time to breathe. Patience is really key in this market because the stats have changed. You need to slow down the rate at which you're making price reductions.
Slow your roll.
Slow your roll. Yes.
Slow your roll.
48.6% of the homes that went under contract last week made a price reduction, and the average price reduction was about 7.3%, or about $33,000 off of your original asking price. 500 to $1 million. This is really where the bulk of our market falls in, with 60.2% of our inventory falling into this category. Cooling trend continued to settle in as we started to watch as we get closer into the holiday season. Month supply of inventory fell by 0.5% this last month. We're now at 2.3 months worth of inventory. Our average daily active count, this is again the bulk of our transactions, 4,049, fell by 3.4%. So we're starting to see that number decline as our new listing count starts to decline as well, with 407 units coming back on market or coming onto the market, which was a decline of about 4.2%. Back on markets ended up jumping up a little bit more, up to 9.8%, making our fallout rate about 10% for transactions that are under $500,000 right now. Withdrawn transactions made that big jump of 4.1%, ended up going withdrawing this last week. Pending transactions fell this last week by 2.9%, or about 399 units going under contract this last week. We saw the odds of selling come in at about 40.5%, so it fell by 1.7% over this last week. So again, we're looking at about a 40.5% odds of selling if you list your home in the next month for it to go under contract and or close. Now, this market is trending closer towards balance than any other market that we're looking at. This is also our most interest rate sensitive category. So with the recent drop in interest rates, I would encourage you to get your buyers out there now to enhance their purchasing power, especially going into this next weekend, and hopefully lock in your rates at a lower rate than what we've seen for the last couple of weeks. But we are sitting at about 38 to 39% of balance in this market. We would need to have about 10,500 homes available for sale to create a market and balance in this position. We saw about 1.3 shows per property per week. Total showings ended up going down week over week by about 1.7%. So fewer showings happened over this last weekend than what we saw over Halloween weekend. We're looking at about 14 shows to go under contract. So again, if you've had a total of 14 showings and no offers, it may be time to consider a price reduction. And median days on market popped up to, it was 28.5. It rounds up down here in my little box down here. It was 29 median days on market in this market. So about 30 days or 1 month to go under contract in this particular market. 59% of all the homes that went under contract last week made a price reduction, which is really significant.
Really high.
So 50.9% of them made price reductions, and the average price reduction was about 7%, but that's down from the 8.1% price reduction that we saw in the last 2 weeks. We saw 8.1 and 8.3% price reductions. And the last time that I saw 8% price reductions was back in May of 2012. And so it's been a long time since we've seen price reductions that have been quite this substantial. For 1 to 1.5 million, we're looking at 7.6% of our market overall. Again, cooling trend continues to settle in as we look deeper into the winter months, but we dropped from 3.2 months worth of inventory to 2.5 months worth of inventory. And part of that is because we saw a drop in our average daily active count by about 2.9%, where we have about 500 units available for sale in this price range, but our pending transaction count jumped week over week by about 23.7%. So it was encouraging to see those numbers and that number get driven down, so inventory isn't hanging out quite as long as what we've been seeing previously. The odds of selling actually went up by 3.8%, which is atypical, but it was nice to see that jump of the odds of selling going up to 39.5%. So if you're listing in the next week or so, in the next month, you have about a 40% chance of going under contract in the first month that you're listed. We're sitting at
list 2 homes.
List 2 homes.
Yeah. So if you've got a 40% chance of selling, you need to list 2 homes.
Yes.
In order to get paid.
In order to get paid. So percent of balance, 27.7% of balance is where we're sitting at right now. We would need to have about 1,800 units available for sale in this market to get to a point of balance. 1.4 shows per property per week in this price range. So if you're not hitting your 1.4 property showings per property per week in this market, you may not be in your strike zone. We're looking at about 15 showings to go under contract. So people are definitely looking at more homes as they go under contract in this next week or so. Median days on market fell from 28 median days on market down to 22 median days on market. There's this really interesting pool of potential buyers that are sitting out there just waiting for the perfect home to come onto market in between $1 to $2 million right now. And once that perfect home comes onto market, they're getting picked up very quickly. I mean, not too long ago, just 3 weeks ago, we were looking at 11 to 15 median days on market. And so again, if you've been on the market for 22 median days, it may be time to consider a price reduction. Price reductions were at about 46.5% of all the homes went under contract with a price reduction last week with an average price reduction of about 7.8% or $105,000 off of the original asking price. And so once you go over $1 million,
Right.
a $100,000 price reduction is customary. A $25,000 price reduction or a $50,000 price reduction probably isn't going to get you there. It needs to be about a $100,000 price reduction in order to get you back in that market. Last market we'll talk about is $1.5 to $2 million. Cooling trend continues to settle in even in this market, dropped off a little bit more this last week. Our predictive month supply of inventory fell from 3.9 months worth of inventory down to about 3.6 months worth of inventory. Average daily active count is sitting at 206, or about 1.5% up from the last week. We did see 22 new listings hit the market in this market this last week, or about 4.8% up. We did see more withdrawns. There were about 7 withdrawn transactions from this market. Pending transactions went up week over week by about 8.3%, or about 13 units went under contract between 1.5 to 2 million. The odds of selling is now sitting at about 30.1%. So if you're listing a home in this market, you've got about a third of a chance of it going under contract in the first month that you're listed. In this market, we're sitting at 30.4% of balance. We would need to be closer to about 700 units available for sale to get to a market in balance in this market. These numbers are really phenomenal.
Yeah.
I remember back when I did this report back in 2007, headed into the recession, we had 12 and a half years worth of inventory in this market. Considering that we only have what? 2 to 3 months worth of inventory in this market is really a substantial number. It's really interesting to see that. We saw about 1 show per property per week, looking at about 17 showings to go under contract. So it's taking a lot longer to get people through these homes. So if you've had a total of 17 showings and no offers, maybe time to consider that price reduction. Median days on market dropped from 51 down to 26 this last week. So a big drop in median days on market was encouraging to see. So again, there's this pool of potential buyers that are sitting out there between 1.5 to 2 million that are just waiting for the right home to pop on the market, and they're ready to make an offer. And so again, it's getting that home show ready and perfect and ready to go. We saw 41% of these homes make price reductions with an average price reduction of about 6.6%, or about $130,000 off of the original asking price. So again, encouraging numbers. Overall, the market's picked up this last week over where we were in the last week. We do have some questions, so we'll rattle through these really quick. Aren't we still in a seller's market given month supply of inventory? It just looks more like a buyer's market. Yes, we are still in a seller's market. However, we're going from 120 miles an hour down to the speed limit at this point. And so again, it's definitely feeling cooler than what we've had in the past. What's the percentage of listings of their prices were reduced? It was 56% of all the listings that went under contract last week reduced their price. Can you do a refresher class on pulling stats and showing time in the additional RE Colorado source that you did that? Yeah. Why don't we do that? Well, we should do that next week.
We could.
We have a live session next week. So I could hop in as long as I have an internet connection. I can go through and show you how to pull stats out of showing time and how to pull those numbers.
And remember quickly on that. So next week, if you're joining us, we're going to do the live market trends, and then we're going to spend 2 hours together, and it's working session. You're not going to hear me rambling for 2 hours, but we are going to be working on our goals, setting that intentional time to develop 2023 the way we want it, right? So if you're going to come in person, we definitely can answer a lot of Q&A, and even Megan can be available to answer questions as we start to migrate into the goal setting. We've got some other fun things, some surprises for you next week as well, but definitely try and join us. We did open up a few additional seats. We were sold out. We got some additional seats, and I think we're sold out again, or very close.
Perfect. So yeah, next week, why don't I do that for you guys next week?
Love that.
Can you provide this detail for properties between 2 and 3 million? I'm only looking at like 5 to 10 homes between 2 to 3 million. So I can't provide that detail, but you can find that detail in the monthly reports. So when I send out the downloads between 11 and 12 o'clock this morning, if you go into the attached residential report or the detached residential report, you can find those numbers there for the month. And so I can only look at those numbers on a monthly basis. Missed days on market for and price reductions in the $1.5 to $2 million price point. I just closed that. I'll send that out to you guys later today. And so I'll send that out in about an hour for you guys. What is the market share for homes under $500,000? It was like 30%, 25 to 30% of all the homes are under $500,000. Do you think that the 1.5 million to $2 million homes market was an ultra luxury market, now the lower tier luxury market, therefore not able apple to apple comparison in terms of the 12 years of inventory you're referring to? Yeah, I would say that the price point of a luxury home has definitely gone up. In Metro Denver, where I'd say that you're considered to be a luxury home once you're in the top 10% of the market, which is over $1.5 million now.
But that stat you threw out as far as how many months of inventory that was existing at that point was across all price points. Now, you related it to the one price point.
Yes.
But it was the entire market.
The entire market had 8 to 9 months worth of inventory when we went into the recession.
So people keep wanting to compare this to 2008. And I could literally sit here for 30 minutes and give you data on why this is different. Now, it doesn't mean we're not going into a recession, and it doesn't mean that we're not going to feel more pain than we're already feeling. It simply means it's different. It's going to be shallower and it's going to be shorter because people have savings and they have equity right now, something that they didn't have before.
Right.
And knowing those numbers and having all that, which we've done over and over, and maybe that's what we do, is just here are 10 slides that you can share as to why this recession is going to be different, because people are starting to feel it differently.
Yes.
And then going into the showing time and
we
data.
can definitely go into that.
Yeah.
Where is the class and what time is the date if you're Zooming, et cetera, for next week?
Same 10 to 11. This period of time is the same. It's at Columbine Country Club. So we'll be serving lunch in between the market trends and the goal setting, and goal setting will happen right after. So it'll be from 11 to 1.
So this is a Nicole question. Do you think the homeowners that did forbearance did not understand it will contribute to a short sale foreclosure market to come? I think that they still have equity in their houses. And so I don't know that they're going to go into short sale or foreclosure at that point. I think that they'll still be able to walk away with a chunk of equity. So I don't think that that's going to really have a huge impact. And what was the total overall percentage of homes that went into forbearance? It was like 2%.
It was so small.
It was so small.
And if you think, so even if you went into forbearance and all of those monies were either tacked on to the end, or your payment is simply coming back, right? And now you're gonna have to pay your mortgage. So all of a sudden this payment no longer works for you. Maybe you did get laid off, or maybe your job had to take a pay cut. You will probably have to sell that home. But even with the additional interest that's been added on to the end of the loan, you probably are still in a positive equity position and simply will sell. I mean, but nobody wants to sell to do what? To rent. So this idea that we're going to see this massive selling off to go to renting doesn't necessarily make sense. People are going to do everything that they can to hold on to that home because you still have those low interest rates.
Yes. Price reductions for under 500K market, I believe, was 46%, if I'm remembering correctly. And again, I'll send out all of those numbers probably around 11:45 this morning. We have a request for 2 seats for next week, if possible. Nicole will send out the registration information a little bit later today, so you'll have the opportunity to register.
If you want to jump on right now, because probably by the time we send out this email, it will be sold out again. Just go to my website, theruthteam.com, and you can click on events, and it'll take you right to the Eventbrite check-in.
Do I track iBuyer inventory? Curious how much Denver will feel the fallout from Redfin, Open Door, et cetera.
Right.
I don't track those numbers. And so I don't know what market share they have or what they look at, but it's a small percentage. It's not a huge percentage overall. So I don't think that those fire sales are really going to have a huge impact in our market.
So I'm going to go ahead and set up my screens for screen share. We're going to keep jumping in on this. There is a lot to cover on my half, and I probably overdid it with slides. I've been really good about limiting my number of slides so I don't have to speed through them. But a big chunk of it is talking about what I talked about on Tuesday's live. So I'm going to keep pointing back to that. If you've got Facebook or Instagram, and we also shared it in our Agent Ignite Facebook group. That was really, it was 25 minutes. It was a little bit, I was going to say it's a little bit longer. I always talk long and I'm sorry, not sorry. But it was all about what are the conversations that you can be having with first-time home buyers. So putting together classes, Audrey Mars and I are doing an online class together for first-time home buyers, doing them in person tonight. As much as it's for investors, it's going to be for first-time home buyers to get them excited about getting into this market. Being attentive, and I'm going to show you a slide. Let's remember, we had the biggest demographic push in demand before the pandemic. That didn't go away. They're just sitting on the sidelines in fear or shock over these interest rates or the fact that they couldn't get in for the last 2 years. And now all of a sudden they can negotiate. So taking advantage of little moments like today, which I'll show you here in a minute, taking advantage of little moments where the interest rates do drop. Do I think it's a downward trend? I think it's a downward trend over a long extended period of time. I don't think we're going to see today's drop and then we're just going to keep dropping. I think that the market's reacted. Sorry, maybe they overreacted. Maybe we saw even a bigger jump that maybe we should have. But either way, we want to take advantage of these moments and helping get somebody off the fence. You're not going to find a new client today that wants to go buy a home in the middle of the holiday season. I mean, let's be honest, right? I mean, blasting this out to your database is probably not going to drum up any more business, but reaching out to every person that's been sitting on the sidelines to simply say, hey, did you know interest rates dropped for this weekend? Would you like to go out? I mean, we still got some inventory and maybe we could do a rehab loan or explore another option. Maybe this is a long-term investment. Maybe you just live in it a year. Might be something worth looking. Do you have any hours available this weekend? Why not have that call? Right?
Yes.
And it's not pushy. It's just informative. All you're doing is telling them, hey, I don't know if you know this, because most people don't psycho track the market like I do, right? You don't want them to, because then they're going to be calling you every minute whenever this stuff happens. All right. So let's go ahead and share our screen. I know we've got some questions. We are going to get to that. I am going to try and go through my slides, not quickly. I don't want to get all New York on you guys, but we're going to go through this. So this is, kind of where we started. Super important. Be a partner. I would ask you this question, and I say it in the kindest way, is, what is your current lender, your current title rep doing to support your growth and your business? It's an evaluation of the partnerships that you hold on to. That's all. And if it makes sense, it makes sense. And if it doesn't, it doesn't. It's not about pressure sales. It's about opportunities and the fact that we're all doing our best to make sure that we're making the most out of these 8 months, 5 months, 18 months. I told my team the other day, I said, if we don't use the next 3 months, right, November, December, and January, January is typically quiet anyway. If we're not using the next 3 months to dive deep into our business, to dial in our client communications, our agent communications, to improve our systems, then shame on us, right? Shame on us for not being better during moments where we can be slow, to not set big goals for next year, knowing realistically where the market is taking us. But interestingly enough, we actually next year, the expected origination volume as a whole, the entire market is estimated to be around 2.3 trillion. I want to go back 2020 to 2010, so backwards, so 2010 to 2020, the average was 1.6 trillion in origination volume. That doesn't even count cash purchases. So it's still going to be a better year next year than it was in 2010 to 2020. Now, the problem is we have a lot of people in lending and in title and in real estate right now. And this will be a market that will shake out. And it will be a market where you want to hook yourself onto somebody who's here for the long run, because they're improving themselves today to make sure that we're serving our clients tomorrow. All right. So next big thing. I cannot be more jazzed up about this. The ticket sales are starting to fly. So we're going to have 450 agents. Did I tell you it was right downtown? I am so excited about this. Last year, we were way up towards Boulder. My team will tell you, I swear we were in Wyoming. That was far for me.
Yes.
I have a very small circle.
Yes.
This time we are downtown and valet is included. You have no excuses. It's one day packed with national speakers. This is going to be the motivation and the restart that you're going to need. Your February self will thank your November self for buying those tickets. I promise you that. And I'm excited to go.
I'm excited. It's going to be great. I'm getting a hotel room this time.
Oh, you are?
Oh,
That's
yeah.
really smart.
Yeah.
I think, yeah, we did that
Just
last
to
time
be there
too.
early.
We do have a hotel room block. So anybody that wants to be exhausted, maybe go out to dinner, download with your teammate, and then just sleep there or sleep there the night before. We do have a room block. All right. So let's get on to the news, because we all know. So last week we talked about the fact that the jobless claims were staying steady, that the consumers weren't feeling it yet. And a big majority of the consumers still aren't. We're still seeing consumer spending, yet the technology sector and the real estate sector and the mortgage sector, obviously, right? We're all feeling it. So the technology sector is, we know that Elon Musk came through and he terminated a large number of Twitter employees. In fact, 7,500. Salesforce came in right behind them and they terminated 20, or laid off, I should say, right? They laid off 2,500. Then we just saw yesterday, Facebook did it as well. And they laid off, gosh, I don't remember, 11,000 people.
Wow.
That was a lot.
Wow.
That was a lot. So,
Wow.
I mean, Freedom Mortgage, Finance of America, Rocket, Lyft, Redfin, Open Door. I mean, all of these companies are laying off. many of them bloated to begin with. Realistically, these tech companies were living off the hog over 2020, 2021, the real estate companies, the lending companies. This is a resizing. This needs to happen in order to get right sized for the next decade. Doesn't feel good. I don't like that it's happening, but it has to happen. And those jobs will get, or those employees will find other jobs. Because remember, we have a massive number of job openings still. They just simply need to be replaced somewhere else, redistributed. So this is all happening. The jobless claims did tick up. So it went up by 7,000. So we see this little bit of a tick up. And I told you, this is what I'm watching on a weekly basis. So if this continues to tick up, we are going to see the unemployment number go up. And remember, the Fed wants to see a 4.4 unemployment rate. They are on track to raising the Fed rate to 5% with the goal to get an unemployment rate of 4.4. Now, given everything that's happening, maybe we'll see that. Now, a little bounce in rates isn't going to necessarily thwart them from their journey, but a CPI report like we saw could at least slow them down. So we'll keep watching on that as well. Consumer debt increase that made headlines this week. It went up by 25 billion in September. Interestingly enough, this is the second smallest increase this year. So it's not, yes, 25 billion is a lot of money, right? And so, but consumer debt increasing across the country. Ultimately, I keep thinking that these credit cards have limits. So at some point, people can't spend anymore, right? I mean, mine has a limit.
Mine has a limit.
I think they all do.
Yes.
So at some point, people will stop spending like they did in 2020 and 2021. And when we see that happening and the GDP starts to come down, and inflation starts to, or continues to come down after it did this morning, when we see that, then the Fed can start to back off their aggressive increase of the Fed rate, right? As we're seeing that inflation coming down, and then even discuss, because remember my quote from last week, they just need to say one thing to see rates come down, that we're going to buy mortgage-backed securities. And we could even see that they do some of that going into next spring if they want to lift up the housing market and get that reset that they've been asking for. So we also have the midterm elections that happened this week. I hope you voted. I did. We saw gridlock, right? And a lot of people are talking about the fact that that's going to help us. I don't know that it's going to help us. I think it was a little overstated. I do think, though, that the gridlock is going to protect the work that the Fed is doing, because if the Fed raises the Fed rate, slows down inflation, this gridlock is going to make it over the next 2 years where the government can't spend as much, right? So it's not going to immediately help us. It's not going to give us lower interest rates. It's simply going to protect something that we're working on right now from undoing by massive spending over the next 2 years. So that's as political as I'm going to get today. The CPI came out this morning and the core dropped. So if you've been watching the last couple of months, the headline's been dropping, which I have over here. The headline dropped from 8.2 to 7.7, which is fantastic. It's been dropping, but the core hadn't been. The core strips out food and gas and energy. And the core dropped month over month. It dropped from 0.6% to 0.3%. You're like, but that's still positive. Yes, but it's slowing way down. It's not negative, but it's slowing down. This aided in the numbers coming down. The markets reacted. And we knew this was coming. We've been talking about this is coming for months, about the fact that we were going to replace this really big number. And if we replace this really big number with anything lower, we were going to see an overall annual inflation number drop. And that's what happened. We replaced the 0.6, which just so happened to be last month's as well. We replaced 0.6 with 0.3, which dropped both the core and the headline down, which gave our markets their rally. We actually saw that the Dow, look at this.
Look at that. Yeah, you were
that
talking
was
about
this
that beforehand. Holy cow.
That was this morning. So we actually saw a 900-point increase. We saw it was even before the market opened, we saw a 600-point increase in the futures. And as soon as the market opened, it went up to 888 something. And then it was quickly even over that. So it's still climbing. The market is excited about the opportunity that maybe, just maybe, we're at the end. Now, don't get married to this yet. I don't want to say this is it. We're at the top. It's just a downward trend from here. I don't want to be that person, right? Because then I'm going to have to eat crow. And on Monday, I'm going to have to tell you that the market turned volatile again. I'm telling you now. But what I am saying is that the market's closed tomorrow. If the market's closed tomorrow, maybe we just get 3 days of this.
Yes.
Right? I just want to I just want to elongate it for a little bit longer and hold on to it. So call your clients, call the ones that have been sitting on the sidelines and let them know that they can get something that's a lower interest rate. Oh, I don't want to do that. Sorry. I had a Microsoft pop up in my face. So let them know that they can get a lower interest rate that's going to save them a little bit of money every month. And then still next year, you're going to have the opportunity to refinance. That does not go away. All right. We also saw the 10-year treasury did a nice little bounce. So it was at 4.2 and immediately dropped down to 3.8. And it's been hovering around there. That 10-year treasury is the thing that's married to our 30-year fixed. All right. So those are more closely aligned, the 10-year treasury yield to the 30-year fixed, because they're both long-term, than the Fed rate. So this 10-year is looking for inflation, because inflation is the arch enemy of bonds. So that was a good, I came in dancing.
That was great.
Yes.
Yeah. The office was all abuzz when I came in this morning. It's like something good happened. What happened?
We were popping champagne at 8 a.m. because why not? Mortgage purchase applications also gave you a nice little gift. They were up 1% week over week. 1% is not a lot. I will take it, right? So a few more people are doing loan applications and they get a little bit of a lower interest rate. This is something to celebrate and get your folks out. So let's run out like we're 8 years old on recess. I mean, this is the time to be excited about what we do. The news is heavy, right? And the atmosphere is solemn, especially with the layoffs. I get it. And especially that, I mean, I'm still getting on debates in social media about how expensive my gas is and how expensive my rent is. And have you gone to a grocery store lately? You're all positive, but really, no, I get it. I get it. I could sit there and I could be upset and bitchy about the fact that my groceries cost more than they did a year ago. Or I can look for the slivers of opportunity that provide the access to real wealth, the access to long-term wealth gain. And that's what we have to stay focused on. Yes, the news is there. Yes, be realistic, but be excited for the opportunities when they present. And this weekend, we got a nice little one because the demographics didn't change, right? These first-time home buyers are still trying to get in. We have to start speaking their language. So 31 years old is the largest singular age group, but the bracket is really big. The 26-year-old to the 34-year-olds is a large group. And those people are wanting to buy homes. They're looking for opportunity. They're looking for the go signal from you, right? To tell them, because everybody's talking in their ear, right? Everybody's talking in their ear. Their friends are, because I've said this before, those same people who were saying you were a hero for getting under contract in March for $100,000 over asking are calling you a fool for getting something $30,000 under asking, even at a 7% interest rate, which is lower than that today, because they think we're at the top of the market. All of those things that we talked about before with the low inventory going into this, the strength of savings, the strength of the overall consumer. Yes, some will feel pain, will support the overall housing market. And in the spring, when a little bit more buyers come out and a little bit more inventory comes out and we have a little bit more activity, and then throughout the year, as the interest rates drops, more of that demand will come in and will pick up that home price almost right away. We're going to see home selling for asking. We're going to see home selling for over asking, because that pent up demand really now for the last 3 years, I mean, you're talking about they were priced out due to home price and not having enough cash. And now they're priced out due to interest rates and fear. And then finally they can get in and they're going to pay for it. So get in now while you can. We've got to be talking to our first time home buyers. Because and I don't even need to talk about this one. We're just talking about how low the foreclosure rate is, which you talked about nationwide. It's not just here. There's just not a lot of inventory and there's not a lot of distressed inventory anywhere you go. It's not like Denver's just a pocket and an oasis. It's a little oasis of expensive, but it's not an oasis of inventory. And the lending standards continue to be way off from where they were before 2008's crash, extremely different. And we're even seeing right now with the recession coming, underwriters are taking even more diligence to determine the stability of their borrowers. Those lower income earners or lower credit scores are being watched as far as, can they really afford this? Where we might have pushed it before, the underwriters are just being a little bit more disconcerting. So that's going to continue to remain as far as a stability factor in our housing market. So here's a report that Black Knight put out, right? So of course it it gained attention in the media and talking about the fact that people are losing value. So we lost the Denver median, and this is based on their numbers, which is going to be a little bit different than DMOR and a little bit different than the numbers you pull. And of course, they're talking about Denver Metro. They're not talking about any of the counties around it. So Denver Metro median price dropped 7% from the 2022 peak, but we're still up 36%, right? We were hovering just around 44%. To see that drop, and there's probably some fractions in there. This is the conversation that we still have the opportunities. You only lose when you sell, right? And that until then, it's unrealized gains or losses. I had a great conversation last night at the class that Karen and Amy were teaching with Scott Norby, and we were talking about a friend of his who he doesn't care if he buys it at the top or the bottom, or as long as it cash flows. He knows long term, and he made his money before real estate, but then he just multiplied it. He knows long term real estate always goes up. It's not about timing the market. It's about getting into the market. It's about stopping with the excuses and the fear and the roadblocks and getting yourself into the market, which is where we come in, right? Which is where you're on the front lines and you're talking the story. And it's where having those partners behind the scenes who are reiterating the story that you're telling, that are confirming that this is the right decision for them, right? If it's the right decision for them, of course. And I keep coming back to this because people are talking about losing money. And this is a little bit dated, and I wish that we had the up through 2022, but of course, when you've got this massive government agency, you're not going to get updated data. It takes them forever to kind of work through this. So this goes through the end of 2019. So take it with a grain of salt, but it is absolutely clear that people lost net wealth in the crash of 2008, right? In that housing bust, they lost net wealth, yet they're coming out. And of course, if you see this in 2020 and 2021, it's going to go way up. Look at these renters. They didn't go up or down. They're just not making anything. Their net wealth isn't happening. So our job, yes, we might lose a little bit. If I bought a house in January, February, or March of 2022, my value might have gone down. And what did you say, 10%?
10%.
Yeah. So I might have lost 10%. So if I bought a $600,000 house, it might be worth 540 today. And that could happen, and it is happening. And could I lose a little bit more? Sure, between now and the spring. But will I regain it back? Yes. And you'll gain it back even faster than this because of the lack of inventory, the stability of the equity, and the fact that people just aren't selling because they're locked in with those low interest rates. All of this, and the alternative is flatlined. This is our opportunity. Because when you look at consumers by income bracket, you have to get up and over $200,000 of net worth before other things other than your home end up aiding in your net wealth. Your home is your primary wealth driver. So for those people who don't own a home and are renting, they're locked out of that. So they don't have any opportunity to get that until they secure net wealth or income opportunities outside of home ownership. And you have to be really good at that. I know some who are dear to us that still rent because they love living the lifestyle, but they've built incredible businesses that have given that income. It's hard to do that for most Americans. Most Americans, their net wealth is in their home. And we know long-term housing always goes up, home values in recessions. So I'm just going to fly through this. There's a handful of slides, but you'll have the slide deck. It's in the Agent Ignite. Of course, you can rewatch the recordings, but really this is the opportunity. Yes, the move up buyers, the second homes are a little bit harder right now, especially with the interest rates. Investors are looking at cap rate, and with interest rates higher, when the interest rates start to go down, you'll see more investors come out. And of course, you still have cash investors. I'm hearing a lot of conversations around that. But the first-time home buyers are still an opportunity. They're still an opportunity because demographics tell us that they are. So if you're talking to these people and you're putting together classes, we would love, Megan loves to go around and talk, don't you?
I do.
You do.
That's what I do all day long. All day long. I might have overdone it this week. I'm kind of tired of the sound of my own voice, but I've talked till I was blue in the face.
You'll be fine by Monday.
I will be fine by Monday. Tomorrow's a day off for me, so I will just be quiet tomorrow. I will sit and Netflix and chill tomorrow.
Can you come in the office and help? We're going to be busy.
No. No,
So
I'm taking my day.
It's fine. Fine. No, we love teaching classes. So now I even have Eric Long, my sales manager, teaching classes with me. So he taught one earlier this week. He's teaching another one next week, where we're going out and teaching classes around first-time homebuyer opportunities, investment opportunities, investment analysis, all the things. Of course, you guys know I can talk about a lot of things, including the market, but these things are important to understand. What is the lending environment going into this new change, right? This 2023, what does this look like and how do I optimize? So first-time home buyers, you should be talking to your VAs. You should be looking, if you have a VA buyer, you should be looking and doing a search on all listings that have the word assumable in it. Because if you're not, you're missing an opportunity. Because if somebody doesn't have a lot of equity, maybe they did just buy it last year and maybe they don't have a ton of equity, but they have to get out of it for one reason or another. The current VA buyer can purchase it from the past VA buyer, and that past VA buyer releases all of their eligibility constraints. So this is a fantastic conversation. And with the less buyers, sellers wanting to sell quickly, VA is an option we're seeing more and more and more of. USDA, know your areas. I mean, if you work Metro Denver, you can ignore USDA, that's fair. But if you work the outskirts, know what areas are in USDA. You might just be surprised. And it's a zero down loan. It's a zero down loan with a very low, and it's assumable. And so if you've got somebody that's selling one, you might be able to capture that. It has a very low upfront MI and a very low monthly MI, and it's no money down. The only problem is it's only single family and no income producing. USDA, the social equity program. Do you know about that one? And that's if you or somebody in your family purchased a home or lived in, didn't even have to own a home, lived in one of these red line areas from 1938 to 2000, you can get this social equity, and it's based on your income, and you can get 15,000 or 25,000. And we have that, and it's tied to MMA. So you can also get down payment assistance along with this silent second, or it's a interest only, 3 years, and then it becomes forgivable. So this is something that you've got to know. It's just another tool you need to have in your tool belt. Down payment assistance, like I pulled up this report of all the down payment assistance programs available.
Mm-hmm. Oh my gosh, look at that.
Right?
That's well, you can cram a lot of stuff onto one page when you shrink the font down real small.
Well, and this is a second page. I kind of second paged it inside the box. So there are a ton of down payment assistance opportunities. Talking to a lender that has the knowledge, the desire. Some lenders are like, I'm not dealing with that. Well, we're doing that, right? And we're not doing that just because we don't have other business. We're doing it because we believe in home ownership. We believe in providing access. And who would I be in what I believe in if we didn't know everything we could know about down payment assistance programs, or dismiss them because we're too busy with high-end buyers, or whatever that is? I want to help the guys that are getting into the $300,000 home as much as, or even lower, as much as a $2 million purchase, right? It is as satisfying to me to make this win. In fact, sometimes it's even a little bit more, because you know how hard they're working to get into that home. The other program that a lot of people dismissed, including us in the Denver market, is the fact that Freddie Mac still does have a 5% down on multi-units. Now, it used to be that if you bought within one of the lower income or designated areas, you could actually do the 5% down no matter how much money you made. That went away. So now it is income limited. So you're not really going to find a multi-unit in Denver where you can put 5% down. But we're licensed in all 50 states and 3 territories, in case you're buying in Puerto Rico.
There you go.
I don't know. I'm not. But you can do 5% down on a multi-unit. We do have one going on in Minnesota. We have somebody else who's looking in Ohio. I pulled this off of Zillow, and I looked at the numbers, and based on the median income that's required for this 5% down, a buyer could buy this home. This is a duplex down in Colorado Springs. A buyer could afford, based on the income, to purchase this home. So it's still here, right? If you can do it. So definitely be creative. Look at these lower price ones if you happen to come on one. If it needs some work, we could also look at a renovation loan. And definitely, we should be all talking about the 3-2-1s and the 2-1 buy downs, but do it how they listen to it. They don't know what a 3-2-1 buy down is or a 2-1 buy down is, but they know when you say, hey, you can get a 4.25 rate, or based on the rates today, because I didn't even change this out this morning, if we're locking in at 6.625 or 6.5, and then I do a 3-2-1 or 2-1 buy down, now I'm talking about rates that I missed out on. at least for the next couple of years, waiting for interest rates to settle in. Now, I don't think interest rates will settle in that low again, but if we could settle in the fives, in the low fives,
that'd be great.
it'd be stable.
I'd be thrilled.
It would be a very stable market.
Interest rate.
And then my team, last slide, my marketing team has been crushing it. They have been developing all kinds of, whether it's social media posts or job aids or worksheets, supporting you, supporting your clients. If you have a need, this is one of the requests that we just got yesterday or the day before, asking for a chart that could quickly show down brackets of payments. We can do all of these things and so much more. Any one of the programs, the 2-1 buy downs, all the social equity, you need flyers, information, social posts, let us know. That is what we love doing. We want to support you and help you as you're continuing to support and help your clients get into the dream of homeownership.
Oh my gosh, we have a lot of questions.
Oh no, we're probably going to go over. Okay. Oh no.
Yeah, 12 questions.
All right, go ahead. Cara jumped in. Only 7 seats for next week. It's probably too late by now because that was at 10:30. Got a ticket. I missed the first couple of minutes. What did rates drop to? So as of before this started, and I don't know what they're doing right this second, but they had dropped down to 6.625. And I was really, really, really excited about that, to see 6.5, 6.625. All right. What do we got here? Could you actually talk more about rehab loans or make a YouTube video about this later as a positive spin for buyers on this market, especially seeing the homes need work under 650? Because we're running out of time, I'm not going to talk about it now, but we have several of them going right now, and we'll absolutely make a YouTube video on it. That's a great request. All right. If a buyer gets an offer accepted this weekend, will they benefit from the drop in interest rates today, or will Monday's rates determine their rate? So we can lock after hours. There's an after hours lock adjustment, but it might be small enough to go ahead and lock in. I don't know that I'd gamble, because a lot can happen over 3 days, especially since you're talking about global effects. We see that all the time with what happens over in Europe and their bond market and how it ripples over our bond market. So yes, if you give me a call, I will take care of your buyer. We'll get an app going and we'll get them locked in this weekend. Oh, I think I just said done to one that wasn't done, but it was about a VA buyer. What event are you talking about? What event are you talking about downtown?
The next big thing.
The next big thing.
The next big thing.
The next big thing is downtown, February 2nd. How much did interest rates actually drop? Yes, down into the mid 6s. Thank you for the deep dives and the opportunities. That's awesome. You guys are rock stars. I love doing these things. What are interest rates today? I answered that. The 5% multi-unit is only for owner occupied. It is. The Ruth team does loans in Puerto Rico. We do. We do. And Guam and the Virgin Islands, because, why not? Thank you for the P&I payment chart. You are very, very welcome. The chart within the principal and interest you just showed is that with 20% down. That's just a loan amount. So it doesn't matter how much it's down. You can back into that 10% down or 20% down. And I had a VA question that I dismissed rather quickly, and I apologize for that. I have to get down to the bottom. Oh, would love a class on loan assumptions. That would be huge. Haha, I got you on that. So we've got we're talking about assumptions next week, or I should say this week. No, it's next week. Next week. It's only Thursday. Eric's teaching it. So that's going to be on our calendar. We're starting to fill up our calendar with all the classes that we're doing for other real estate agents as well, or just even broad ones. This one just happens to be with an association, not with a real estate agent. So watch for any of those. We're going to start populating our calendar, but that is, and we will be sending out an announcement for the assumptions class. And we'll do, I know I've done a live on it, and I'm sure we'll do more videos on that too.
Definitely. That's a good thing to have right now.
All right.
Awesome. That wraps us up. You want to close us out?
Yes. So you guys, and I'm gonna bring the energy down, right? It's not about us. It's not about us. It's not even about Megan and I, although we like to make it about us every once in a while. Like how I started it out.
A little bit.
But it's not ultimately about us. And it's really not even about you. It's about being a conduit for compassionate education, right? Helping your clients burrow their way through the noise and the fear and get to the other side, where if home ownership is in their future, you help them find the path to get there sooner than later, because time is one of the best advantages to real estate. with that, I'm going to send you on your way. To all of our veterans, thank you for your service. Tomorrow is your day. I hope you get some time off and get to celebrate. I know Megan does cherish what you've done for your country and for us, so that we can have the freedoms that we have. Tomorrow is Veterans Day. This weekend should be a hot one. I will be working. My cell phone will be on. My team will be working. We'll have that in our Saturday post. You guys have a great weekend, and we'll talk to you very soon.
Thanks, guys. We'll see you soon.